All right, welcome to the Explainer. Today, we're going to pull back the curtain on the stock market. Forget the scrolling numbers you see on TV for a second. We're diving into what's really happening behind the scenes, the actual mechanics of how it all works. You see a company you like, you pull out your phone, open up an app, and tap buy. And bam, seconds later, it's done. It feels like magic, right? But it's not. It's an incredibly fascinating, high-speed system. So let's break down that magic.
So here's our game plan. First, we'll get a handle on what an equity market is even for. Then we'll break down its two main jobs, the primary and secondary markets. After that, we get to the main event, the two different engines that make trades happen, which are the order-driven and quote-driven systems. And then we'll wrap it all up with why any of this actually matters to you as an investor.
Okay, so at its very core, a stock market exists to solve one enormous problem. Just think about it. How do you get millions of total strangers who all want to buy or sell shares at different times for different prices to somehow find each other and trade fairly and instantly?
And the answer, of course, is the stock exchange. It's not just a fancy building or a website. It's a whole system. It's an organized marketplace with a clear set of rules that brings all those strangers together, whether it's digitally or in person, to trade in a structured, reliable way.
Now, what's really interesting is that every stock exchange is actually doing two totally different but completely connected jobs. They're running two different markets at the same time, the primary market and the secondary market. So you've got the primary market on one side. This is where shares are born, literally. It's where a company creates new stock and sells it to the public for the first time to raise money. Think of an IPO. And then you have the secondary market. This is what we all think of as the stock market. It's where you and I and everyone else trade those shares that already exist among ourselves. The company itself isn't involved in those day-to-day trades. And this is absolutely the key takeaway. The primary market simply couldn't work without the secondary market. I mean, think about it. Why on earth would you buy brand new shares from a company if there was no way to ever sell them later on? The secondary market gives you that ability to sell, that liquidity, and that's what gives people the confidence to invest in the first place. Okay, so we're in the secondary market. You've just hit that buy button. How does your order magically find someone who's selling? Well, this is where we get into the real engine room of the market. There are two main systems for making that happen. These two systems are called order-driven and quote-driven, and they have totally different philosophies on how to connect a buyer and a seller. Pretty much every major stock exchange in the world uses some version of one or the other. So let's break them down.
First up, we've got the order-driven system. And honestly, the best way to think about this is like a giant, super fast automated queue. It's all about getting in line, and the people with the best prices get to jump to the front.
Yup, it really is all about the queue. This whole queue is organized in what's called an electronic order book. It looks complicated, but it's super logical. On the left, you've got the buy queue. These are the highest prices people are willing to pay. On the right, the sell queue, the lowest prices people are willing to sell for. The system's rules are dead simple. Priority number one is the best price. So if a new buy order comes in, it's going to match with that seller at 1.25 pounds. But what if two orders come in at the same price, like those two sell orders at 1.26 pounds? Well, then it's first come, first served. The order that got there first gets priority. Price, then time. That's the whole game. So to quickly recap the order-driven system, it's all about that electronic order book directly matching buyers and sellers. There's no middleman, no market maker needed. The priority is simple. Best price wins, and ties are broken by who was first. The price you see is just pure, raw supply and demand at that very instant. All right, let's switch gears to the second system, the quote-driven market. This thing works on a completely different principle. Instead of one big central queue for everyone, it relies on a group of professionals who are always standing by, ready to both buy and sell.
And these key players are called market makers. You can think of them as wholesalers for stocks. It's their full-time job to provide liquidity to the market by constantly advertising two prices. A price they're willing to buy at, called the bid, and a slightly higher price they're willing to sell at, called the offer.
So how does a trade actually happen here? Well, let's say you tell your broker you want to buy some shares. Instead of just putting your order into a queue, your broker basically goes shopping. They'll ping several of these competing market makers and ask, hey, what's your best sell price right now? They then find the lowest offer and execute your trade with that market maker. It's a system built on fierce competition. And this diagram shows it perfectly. Your broker, acting on your behalf, gets quotes from market makers A, B, C, and D.
Market maker B comes back with the lowest sell price, $4.98. So that's who your broker does the deal with, getting you the best possible price at that moment. So the big features here are that liquidity comes from these market makers, not a big public queue. They make their money on the spread, that tiny little gap between their buy and sell prices. And this is critical, they are required to keep providing those prices, even when the market gets wild. The Nasdaq, by the way, is a famous example of this kind of system.
Okay, so we've got these two different engines, order-driven and quote-driven. They're both pretty complex. But why should you care? Well, because understanding how they work is the key to understanding where the price of a stock actually comes from. Let's put them side by side one last time. In an order-driven market, the price is set by the pure, raw forces of supply and demand from everyone trading. But that system needs a lot of people trading all the time to work well. In a quote-driven market, the price is set by professionals competing with each other. The big advantage there is that they guarantee there's always someone to trade with, even in a stock that isn't traded very often. So next time you see a stock price, remember that behind that single number, one of these two powerful engines is churning away. It isn't magic. It's just a highly organized, incredibly fast machine built to connect millions of us instantly.
And all of this leaves us with a really big question to think about. What creates a fairer price? Is it the price that comes directly from the unfiltered wants of every single buyer and seller out there? Or is it the price guaranteed by professionals who are competing to give you the best deal they can? There's no easy answer, and that debate is right at the very heart of how our stock markets are designed.